Thanks for joining us on Switzer Investing. I'm Paul Rickard, filling in for Peter Switzer. On tonight's show, Shane Oliver, the Chief Economist and Head of Investment Strategy at the AMP, has a look back at the reporting season to see what we can glean from that, but also talks about the current debate going on in the US between the Fed, how tough is it going to be, and what does it mean for the market. And surprisingly, well, not surprised if you know Shane, he's just a touch bullish. He's not saying that the market bottomed in June, but he's feeling fairly comfortable and sees the risk of recession, particularly in Australia, as less than 30%. To close out the show, we'll have Arjun Paliwal from Investor Kit, and another one who's a bit bullish, this time on the property market. Now, we've seen some pretty ordinary data come out from CoreLogic about the ongoing downtrend, but Arjun says that the underlying factors are pretty strong, and that should actually support the market, particularly in some of those hotspots. But to kick off today's show, let me share with you my thoughts about the market, particularly the outlook in September, and I do that by having a look back first at what's happened in August. Today, I want to look at the outlook for the market in September. What's in store? But as always, let's have a quick refresh on what happened in August. Look, a second positive month for the ASX, despite some negative pressures coming out of the United States. The market up 0.6% in price terms, 1.2% when you add dividends, for a year-to-date negative position of down 6.2 on the ASX 200, a negative 3.6% when dividends are factored in. Interesting, the top part of the market, that's the top 20 stocks, still doing better. They're only down 1% year-to-date. Compare that to the so-called mid-cap 50. That stock's numbered 51 to 100 by market capitalisation, down about 5.5%. And the bottom end of the market is doing even worse. Looking at the industry sectors, still the clear standout is the energy sector, up 7.8% again in August to be up 43.7%. So that's companies the likes of mainly like Woodside, but also you can throw in Santos and some other energy majors in that league. On the negative side, the IT sector, although it's only weights at 3% of the index, is down 27.7% year to date. In August, most sectors were either small positive, small negative. The biggest sector by market weighting, the financial sector, lost 0.6% to be only down 2.1% year to date. But really, it's a tale of sort of energy on the top end, IT at the other end, and the rest of the market sort of not doing a lot. I think one of the standouts from August as well was the real estate sector, really because of the pressure of higher interest rates, down 3.2% and down 16.7% year to date. And on the upside, look, the communications services sector, mainly due to the likes of Telstra, but also companies like REA, up 2.6% in the month of August. Okay. That's enough about talking about the past. Let's look to the future. Now, we all know that September, historically, particularly September and October, are the scariest months in the market. And any of the data will show that they're historically done less well than other months. That doesn't mean they always lose money. In fact, the statistics say they will more often go up than go down. But there have been a lot of big falls in September and October. So the market tends to get just a little more nervous. Now, in the United States, it continues to be this ongoing battle between inflation, interest rates and recession. How hard does the US Federal Reserve go to actually combat inflation, and does it put the economy into recession, and what that means for the stock market? Now, in the last week or so of August, we saw the market, particularly after the Fed governor made a statement, turn around from really a summertime rally, you'd call it, and then really start to fret again about the fact that the Fed looks like it'll go at least 0.75% when it meets in September the 20th and the 21st. Plus there could be more short-term increases. The curve inverted even further, so the 2-year rates went up, the 10-year rates didn't go up as much, so the gap between the 2-year bond and the 10-year bond got wider. That's often considered to be a predictor of recession. So you've got to say there is some probability of recession looming in the United States. But inflation, at least in August, was better, and hopefully we'll start to see a better figure in September as well. In Australia, it's going to be a little quieter month because we've got through reporting season, which generally wasn't too bad for the market. The Reserve Bank meets on Tuesday. National accounts is the big number out at the end of the month. I don't think we're going to see the June quarter into recession, but there'll be focus on that on September 29. And also for some of the stocks involved in sectors like healthcare and education and other sectors where the government gets involved. Don't forget that the Labor's first budget is due out in October 25, so we may see some things coming out there. Overall, I think September is going to be a tricky month for the market. It certainly wants to see confirmation from the action of central banks. If inflation is better when the September data comes out in the States, the market's going to like that. It wants to see, a stable to perhaps a falling oil price, and it wants to get a good sense that the central banks aren't going to take it too far. In other words, they're going to be a bit nuanced. And my take was that was what the Federal Reserve Governor was actually saying the other day. We're actually going to be more nuanced. Locally, though, you've got to say reporting season was a positive. So September, October looked like rather tricky months, but I would say, I'd be surprised if we retest the June low. Looking at the charts, and we're going to take the lead from the US, you can see that despite the rally in July and August, the US market really hasn't broke its long-term trend. At the moment, that's still in a negative sense, because on that graph at least, the shorter-term moving averages, the 30-day moving average is actually below the 300-day moving average, which is below the S&P 500. So the market's still looking like they want to go south. The question is, will they retest the June lows? My hunch is if they do, we're not going to get much lower. If anything, I think when we get through September, October, we're going to be looking at higher prices overall. I'm joined by Shane Oliver, the Chief Economist and Head of Investment Strategy at the AMP. Shane, welcome to the program.
Thanks, Paul. Great to be here.
Yeah, look, let me start off by just talking about what we've seen in the last, since last Friday, our time with the US Federal Reserve, and an apparent sort of hardening about the willingness to fight inflation and send interest rates up. What do you make of that and how the markets reacted to that news?
But to be honest with you, I wasn't particularly surprised by what Jerome Powell said at Jackson Hole. I think markets, or the share markets anyway, sort of got ahead of themselves. I think they were hoping for some sort of dovish pivot from the Fed, and we didn't really get that. We got a collection of phrases that he's used in the past, but the combination of them was more on the hawkish side. In other words, continuing with what they've been doing, the need to get inflation down, the likelihood that there'll be some pain along the way. I mean, it didn't particularly surprise me, and I don't think it particularly surprised the bond markets, but it obviously did surprise equity markets, which had rallied very hard from the June lows, and that had left share markets vulnerable. So now share markets have gone back to, yet again, worrying about how high the Fed will go in interest rates, how high other central banks will tighten, and whether we'll have a recession and how severe that recession will be. And of course, this has come at a time when ECB officials have also been hawkish, and of course overnight we got some more high inflation numbers, or surprising on the upside, in Europe. So it's still this messy picture of worries about inflation, worries about recession, and worries about how high interest rates will go. I mean, there is a bit of light at the end of the tunnel, and there has been for a few months now, and that is forward-looking indicators for inflation in the US have rolled over. We've probably seen the peak in US inflation, but I guess the Fed says, well, inflation may have peaked, but it's still too high, so therefore we've still got some more work to do.
So there is, we have seen the US yield curve, I guess, flatten a little bit. The 2-year rate has gone up a bit, and the 10-year rate has probably, I won't say it's edged down, but at least that margin's widened a little bit. A lot of people like to say, oh, that's a forerunner of a recession in the States. What do you say to that, and what probability do you assign to the chance of a recession in the US?
I think in the US it's 50-50. The 10-year, what they call the gap between the 10-year bond yield and the 2-year bond yield has inverted. It's been inverted for a little while now, a couple of months, I think. The gap between the 10-year and the Fed funds rate has not yet inverted. Historically, you don't have recessions unless that gap inverts. We're not there yet, but it probably will invert if the Fed keeps raising interest rates at this rate. I mean, history of these things is that inverted yield curves, that's where short-term rates are higher than long-term rates, do tend to lead recessions. That's why markets are worried about it. But by the same token, it's not a perfect guide. You do get some false messages sometimes. And the gap between the inversion and recession could be as long as 18 months. In other words, we could still be waiting out to the second half of next year or late next year before we get the recession. I mean, I don't regard the 2 quarters of negative growth we saw in the US earlier this year as a recession. Income growth was still strong, jobs market was still strong. So I don't think that'll be defined as a recession, but that recession risk is still significant out there next year, probably in the second half of next year. So that's clearly something to keep an eye on. And I'd rate that risk as 50-50. Perhaps the biggest issue now, given that markets are already still down, way down from their highs, and we did see a 24% fall in US share market into June, the bigger issue is not so much whether we're going to have a recession, because you could argue that's already factored into share markets, but whether it's a deep one or a mild one. If it's a deep one, yes, then we've got a lot more downside to share markets. But if it's a relatively mild and brief one, as I think is more likely, then share markets, yes, may come back down and go below their lows, but we won't have a lot more downside. And that, I either lean to the view that we'll manage to just avoid a recession, or if we do have one, it'll be a relatively mild one, because we don't have the imbalances going into this recession that we've had in the past. Yeah, sure, inflation's a problem, but the level of household debt in the US is well down, and we haven't seen overinvestment, which normally precedes recessions as well. So that's why I think if you do have a recession, it'll be a mild one.
So I won't put you on the spot and ask you whether you think that we bottom back in the 17th or 18th of June, but it sounds like you are sort of suggesting it's going to be a mild recession in the US, if one at all. What about Australia? Is it differently placed to the States, notwithstanding that, when the US, that phrase they're going, they sneeze, we catch the cold, I mean, vice versa. So how's Australia positioned for this, for any sort of discussion about a recession in the US?
It's a good question. I think the risk of recession here is 30%. It's a lot less than in the US. That old saying, if the US sneezes, we get a cold, applied up until the early 90s. I mean, they had recessions and we had deeper ones in the 70s, 80s and 90s. But ever since then, they've had recessions, quite a few of them. And we haven't. The tech wreck and the GFC were classic examples of that, recessions we managed to avoid. And our central bank has a better track record. I mean, everyone seems to be criticising the Reserve Bank lately, mainly given its comment about the no rate hike until 2024. But if you go back through time, we've seen lots of tightening cycles, 4 tightening cycles before this one, starting in mid-1994, 2002, 1999, and also 2009. And those tightening cycles, and also 2002, I think I mentioned in there, those tightening cycles didn't result in recessions in Australia. So there is a bit of a track record in Australia, a better track record in Australia of getting inflation under control without having to have a recession. So I think the risk here is much lower than it is in the US. It's a 30% chance of recession. It's significant, you can't ignore it. But I don't think we'll go into recession. The other point to note is that our inflation rate is not as high as in the US. The US has got up to 9%. They've got wages growth, depending on which measure you look at, around 5 or 6%. We've got inflation here probably going up to 7%, got more upside, but we've got wages growth currently 2.5%, maybe on its way to 3.5, 4, but still well below that in the US, which means the Reserve Bank won't have to raise interest rates as much to control inflationary expectations in Australia. Which is another reason why I think the odds of avoiding recession in Australia are much higher.
Well, thinking with that sort of slightly more positive tone, we've just finished reporting season, and you keep a pretty close eye on all the numbers. So over to you. What's the overall summary of reporting season, and what have we learned in terms of the outlook for company profits going forward?
Look, I think it wasn't fantastic in the sense that some of my charts that track it have been starting to slow, but by the same token, it was okay. It was, in some ways, you'd say it's pretty good. The last financial year, we saw earnings growth of around almost 22%. And if you think about it, a year ago, we were stuck in a lockdown in New South Wales and Victoria. We had the Omicron disruptions. We've had worker shortages. We've had surges in the price of basic inputs to what companies do, disruptions to demand and so on. And yet they've been able to generate pretty good earnings growth through the last reporting season. So that's the good news. And the odds are we're probably going to see continued earnings growth this financial year, but not as much as it was last financial year. So I guess that's the bad news. Looking beneath the numbers, I saw something like 35% of companies surprised on the upside, which is a ratio of 3 to 2 in terms of companies surprising on the downside, which is good. But that upside surprise has been diminishing. And we've also seen a slowing in the number of companies reporting profits up on a year ago, and a slowing in the number of companies reporting dividends up on a year ago. So basically, earnings growth was very strong through the last financial year, but it is starting to slow down. And consistent with that, we've seen analysts revise down their earnings growth expectations for this financial year to around 6.5%. From around, I think, about 8% at the start of the reporting season. So that's probably the biggest downer in all of this. But it's not so bad as to say, well, sell shares, panic, all that sort of stuff. I thought overall the earnings reporting season here helped support the market. You were wondering, well, why did shares rally over the last few weeks until the little pick up lately? It was because of those earnings numbers, which were overall supportive. Similar story to what we saw in the US through the June quarter earnings reporting season, but you just got to bear in mind we are going to see much slower profit growth in this financial year compared to last financial year.
And what about the tone of the reports? I was expecting companies to be pretty conservative in terms of their outlook statements, particularly given the unknowns about the economy and recession risk and inflation and supply chain pressures in terms of input prices. I didn't quite get a sense that they were as conservative and as cautious as I'd expected. I wondered whether there's any data to support that, or you agree with that statement.
Oh, no, I agree with that. The companies, there's a lot of companies that didn't offer any outlook statements, but those that did, there were some negatives in there, and some companies will clearly struggle, but it seems as if companies have managed through this difficult period reasonably well. And that's why there wasn't a sense of doom and gloom on the part of corporate Australia. Things will slow down, but they're managing these disruptions, fairly well. That's evident in numbers themselves. Margins have held up. There are some challenges coming forward because wage pressures will continue to increase, and higher interest rates will mean less demand. But I didn't get the impression from companies that they thought that was going to cause a collapse in their profits, which I think is a good sign. We're going to see a slowing. It's inevitable after the big recovery in profits and the economy from the lockdowns. So it's inevitable we're going to see a slowing, but there's nothing in there pointing to a crash in company profits, just a slowing in growth. And if that's the case, yes, we'll see some volatility in share markets, or continuing like we have, given the global concerns, given the Reserve Bank still raising interest rates. But we're not talking about a crash scenario here. Things could worsen, but as things stand at present, we're looking at, potentially more downside, maybe a retest of the lows we saw in June could go a bit below that, but not a whole new leg down in shares like we saw at the time of the GFC, for example.
So putting that together, 6.5% profit growth, low risk of recession in Australia, maybe higher interest rates, a little bit of nervousness overseas. Sounds like you're, from a strategic point of view, you see the market as reasonably well positioned. I don't want to word marry you or wordsmith you, but is that a fair synopsis of the Shane Oliver view on the stock market at the moment?
Short-term nervousness. We could have some rough months. We are in September now.
Yep.
September is known for volatility, as is October. But I think beyond that, I think later in the year we'll get more clarity that central banks, or at least the Fed, the Fed is the one that really counts globally, because it led the way on the way up. It's going to lead the way going forward. We'll get more clarity that I think they're getting closer to slowing down the process of hiking. Similarly, in Australia, we'll get more clarity on that front as well. And I think this combination of better valuations, you're talking about PEs now 15 times, not 18 or 20 times, some settling in bond yields, managing to avoid a recession, that suggests the share market should do reasonably well on a 12-month basis, even though I still have those concerns about the next couple of months.
We'll leave it there.
You wouldn't necessarily be piling in now, but you might be looking for opportunities that would be thrown up over the next couple of months.
Well, we almost I think we got a fairly positive assessment from you, Shane, so I don't want to verbal you, but we'll leave it there. That's Shane Oliver, the Head of Investment Strategy and Chief Economist with the AMP. Well, despite what you might read in the mainstream press, one property expert says the property market is very strong. In fact, headed a press release saying that Australia's housing outlook is strong, despite lack of nationwide blanket capital growth. That's Arjun Paliwal. He's the Head of Research and the founder of InvestorKit, and he joins me now. Arjun, thank you for joining us.
Thank you for having me on, my friend.
So everything I read in terms of the mainstream press is that the property market's in a lot of trouble and there's going to be a lot of mortgage stress, but you say it's actually strong. So maybe you could just share your thinking for, why are you different and everyone else is feeling so negative on the market?
I think the core part is not falling in love with any one thing, my friend. It's really about a holistic overview of housing fundamentals. We categorize fundamentals across three core categories: underlying demand, housing supply, and confidence. Mm-hmm. And after breaking this down, we came up with what we felt were the core indicators of fundamentals. And we found 25. Now, of the 25, if you were to make it an exam or some sort of test, you'd say that anything under 14, you're probably flunking your exams, right? And as a result, you're probably flunking your housing fundamentals or performance for housing. We sit today at a level that's 17 of 25 when it comes to either strong or very strong fundamentals, 18 when you include the balanced. So I guess this is a core thing to say that really the picture isn't as bad as what everyone might be saying.
Okay, so you've got 18 out of 25 fundamentals are either strong or balanced. How does that compare to, say, 6 months ago or 12 months ago?
That's a great question because there is a change in trends. This time last year, or this time earlier this year, we did count that there were 22 of 25 fundamentals, either strong, very strong. And this is important to note that there has been a slide down. But when we think of what's really been the slide down, it has been, number one, borrowing capacity, which is reduced in line with the changes of interest rates. Number two, in my opinion, not so much the actual change of interest rates, it's A, the rapid change of them, and then B, the lack of certainty on how far they go in comparison to previous representation by the RBA versus what actually happened. So I think that's the second core part. The third part is due to rapid price growth again and again and again. Our pre-pandemic price to income ratio sat at about 6.8 and now they sit at about 8.5. Now, in isolation, none of these indicators are clear dropping off or absolute loss of housing fundamental strength, but they are contributing to the slowdown because they move from that point of 22 fundamentals down to 17. And some other things I haven't quite mentioned are the consumer sentiment index. And something lastly to throw in there is the media cycle tracking. So this is something very unique to us. We had our research team sit down and review the last 90 days of journalism in Australia amongst our top 3 media journalists in terms of by volume or market share in Australia when it comes to property, release. And we tracked that only 24.7% were in the positive category of releases over the last 90 days. So that does definitely show that sentiment from a perspective of media cycle, consumer sentiment index, and some of those other parts were the shifting fundamentals from last year versus now.
Yeah, look, I have to add to that. Look, my experience is that the media is wrong 8 out of 10 times, and that's because what they do know is the scary headlines sell eyeballs and newspapers. So the story's always on the negative side. Look, let's come to the just before we go off the fundamentals. They're obviously a mixture of demand and supply. I presume all the supply factors are still pretty strong because there isn't much new supply being built, is there?
You're very, very much correct there. So this is a core part around some of the fundamentals that do remain in a very strong position. Talking about supply, we looked at this in 3 different parts. One was assets for sale, so for sale listings. This is still down 31.9% compared to pre-COVID levels, but it's also down 33.6% compared to 5 years ago. If that doesn't demonstrate a severe housing shortage, I don't know what will. Now, this is the core part of what makes some of the cities move and diverge in different performances, because we are seeing a greater slowdown and decline in the likes of some of our bigger capitals. That is because their 5-year averages of supply for sale is actually at a balanced level. It's just that the rest of Australia is in such a shortage of supply, which is why we are still at 31.9% lower than pre-COVID for sale listings. If we move on to rental vacancy rates, we're at the lowest level since 2007. Vacancy rates as of June ending data are at 1.2% nationwide. They're even lower as we stretch the data out to July, August.
Yeah,
rising rents are definitely a core part there as well.
Yeah, so when you look around and you look at what's happening in rental returns and rental vacancy rates are so low, you hear all the stories about how long it's taking to get anything built, and we know a lot of builders are facing rising costs and can't get tradespeople. And then at some stage they're going to turn the immigration tap on again. It's sort of hard, I think, just looking around at the anecdotal data, despite interest rates going up, and it's obviously harder for people can't borrow as much, it's hard to get too bearish on the market. So I'm not surprised that there hasn't been that big a shift in some of your factors over those 12 months.
Well, I'm seeing that the 17 of 25 that we're at now, to the point that you raise around the borders, I'm predicting that our fundamentals will actually rise from 17 of 25 to 19 of 25. And the reason why is the 2 fundamentals that we scored as weak in Australia were international visitors, down 65% with May ending data going back from, compared to May 2019 pre-COVID. So that bounce back is imminent and very likely to happen soon. The net overseas migration is also ranked as a weak fundamental by us, because when we consider how low it was, some of the lowest since, on record since World War I due to the pandemic and the big lockdowns. So that too, over time, as visa processing backlogs, as normality occurs, as rules between countries change and people start to move from dipping toes in the water to actually getting fully in the traveling around the globe and shifting lives, that's 2 fundamentals out of the 25 that we've ranked as weak that will bounce back. So the position is still definitely healthy, especially we add into some of the unmentioned parts now with regards to unemployment rates, job advertisements, infrastructure investments, just to name a few.
Okay, let's move on to some of the areas that you think potentially have the best prospects going forward. Very much a bias towards some of the smaller states and regional areas and some sort of provincial cities. So let me just start with a couple that you've mentioned. One is Greater Adelaide. Now, that's obviously a capital city, but that's on the outskirts of Adelaide. Just sort of go through the drivers for Greater Adelaide.
Yeah, so when we came up with these list of cities, what we wanted to take into account was a mix of lead and lag indicators. And taking into account Adelaide as one call out, the first thing we looked at was putting all these indicators together and calling it market pressure. Adelaide's asking prices have still been increasing. They actually increased for the quarter at just under 2%. So annualizing that in a period where we're seeing nationwide slowdown is still a healthy number. Total listings have also still dropped 4% over the quarter. So just when we thought listings were getting better, they weren't really, and Adelaide isn't one example. Listings still remain between 30 and 45% in many parts of Adelaide's below pre-pandemic levels. But we have to admit, after years of great growth, sales volumes are starting to flatten out a little bit, and vendor discounting rates have bounced from the absolute bottom. Unrealistic, though, is one core part, which is how much growth can keep going at these levels, because that can't keep happening. It just doesn't happen when we look at our long term. But in terms of pressure overall in Adelaide, from low supply, a very strong economy, and we're extremely undersupplied rental market, the pressure still remains high.
Yeah. Okay. And then another area was Darwin, or Greater Darwin, I think you described it as. Look, for a lot of investors, that's a long way away. I mean, so how do you sort of reconcile? Most people aren't going to get on a plane to go and visit property to think about Greater Darwin. So is that a realistic option for investors in, say, Sydney or Melbourne or Brisbane?
Yeah, so this particular list, when we included cities like Darwin, we again just came back to that pressure point. It isn't so much a list to say, hey, these cities are just booming with investment prospect and they are definitely ripe for investing. They're just showing signs that, hey, whilst the country goes through an overall blanket shift in demand, they still remain extremely insulated because of a few pressure data points. So the example here is that quarterly asking prices for Darwin have actually risen by 3.8%, which annualized is a double-digit rate of growth. What has been something that's very unique to Darwin and quite interesting actually is that sales listings have continued rising in Darwin even as the sales volumes have come up as well, which is a sign that maybe people seeing this growth in Darwin are using it as an opportunity to quickly get out because they might not have seen many years of great growth in the past. So they're using it as a way to, have held it long enough. I see this as a great opportunity to get out, because we did notice something unique about Darwin, that whilst its prices were rising, its sales volumes were healthy, we were also seeing listings pick up. So it showed a clear sign of people getting in and out, something unique to it.
Yeah, and I suppose there are a lot of factors in places like Darwin because of, in terms of, there's an orientation around defence and government and other key industries. So I guess you've got to have a view about, what's going to happen in some of those things. Is that's just a bit of caution there before everyone races off and thinks about Darwin, right?
Yeah, correct. I think this is a short-term pressure overview, which shows that it's well placed on that angle. However, from an investment perspective, definitely more broad approach, more broad thinking, macro, also from their economics as to whether it's comfortable for them or not.
Yeah. And the last one I want to pick on is Launceston, a particular favourite city of mine. Look, Hobart's, we know, has had a great boom. People have been saying Hobart's got too hot. Is that just a spread of people sort of moving out of Hobart or looking for perhaps somewhere a little bit cheaper, 2-hour commute roughly, potentially, or is that just a function of, great place to live with great amenities around it?
Yeah, this first concept you mentioned, which is something interesting that many people do fall guilty of, is something too hot for too long. It's been very hard to figure out when that ending point would be of a cycle like Hobart, regional Tasmania, because these areas have kept on, keeping on since early 2016. So this is a very, very interesting to see that we're now 6 years into some of the cycle or growth cycle for many cities. And this is quite rare when it comes to Australian property. Even the likes of Sydney, Melbourne, and others saw an extended 3 to 5 or 4 to 6 years of growth. But these cities don't seem to have any steam that's majorly falling off. Listings in Launceston are down 16% over the last quarter, and they remain well below peak levels. Sales volumes have stabilized at a slightly lower level, and vendor discounting is a little bit higher, but they're still at very, very strong levels. Now, we've seen over 100% price growth in Launceston over a 10-year average, and the majority of that came in over the last 5 or 6 years. The rental listing is still extremely low. Vacancy rates remain at 1%, and investors can still see a healthy rental yield, and that's because rents have risen over 64% over the last decade, sitting with a healthy yield of 4.3%. As long as these supply conditions remain in the likes of Hobart and Launceston, and even out to Burnie and Devonport, this growth cycle that they're in doesn't seem to be falling off anytime soon. Although rates of growth have most definitely slowed, and the building approval pipeline seems to be, getting a lot of heat into it, which means that the pressure eventually needs to come off, especially after levels of price growth like this. But they've been remarkable examples of absolute outperformance in comparison to the rest of the country over the last 6 years.
Thanks for joining us on Switzer.
Thank you, my friend. Cheers.
Well, great to see someone who's so positive about the market because we do get so much negativity and sometimes the fundamentals just speak for themselves. That was Arjun Paliwal. He's the founder and head of research at InvestorKit. They're a buyer's agent. That's the show for tonight. For more insights, head to switzerreport.com.au. I'm Paul Rickard, filling in for Peter Switzer.